So hello to everyone who's joining us today. Welcome to our webinar from the Agent Education Program. For those of you who don't know me, my name is Kelsey. I am the program coordinator here at the Agent Education Program at Quote Wizard. And I am so excited to be joined today by Club Capital. They're going to be sharing 5 tips for minimizing your agency's taxes for 2020, which is so important. Saving money is always great. Club Capital, just a brief background, they are the largest accounting and advisory firm for insurance agency owners in the country. They provide a one-stop financial infrastructure that includes monthly accounting, integrated payroll, CFO services, and tax preparation. They are the best in the biz. So without further ado, I'm going to pass the mic to Club Capital's co-founder, Micah Cannon, to take it away and introduce today's speakers.
Awesome. Thanks so much, Kelsey. Thanks for having us on here today. As Kelsey just mentioned, we are the largest agency-focused accounting and advisory firm in the country. So really starting with monthly accounting, obviously doing taxes, and CFO services, really to be able to take really the next step, an advanced step in taking control of your financials, working with customized budgeting, forecasting. We start with the best technology in the business. Outside of just taxes, everybody in the agency world has a payroll platform, has a CPA that they've done some business with. We really start with wanting to really help agency owners really excel to the best possible capability as a business owner. So our bread and butter and our foundational essentials that we start with is the monthly accounting. To be able to make better informed decisions for your business, you have got to be on top of your financials monthly, not just looking at your financials from a tax perspective at year end. So, 100% of our clients work with us on the accounting side, 90% of them work with us on taxes. And so what we want to do today is be able to introduce and share some tips from our tax experts, as it's obviously that time of year. And we want to make sure that everybody has the best advice in front of them, and especially just some top tips to make sure you're thinking about for your taxes, that you bring to your own CPA for maybe some specific questions, or if you do need some help, obviously we can be able to help you as well. So to be able to introduce some of the team, this is me as partner and COO of the firm. Joining us today, we also have Javier Golden, CPA. He is the co-founder and lead CPA of Club Capital. He has a tremendous background and has held roles such as chief of accounting, chief of reporting for the past couple of decades. He's also the managing partner of Golden Group CPAs, which is located in Bethesda, Maryland, and obviously our co-founder. We have Brian McCool, who's an enrolled agent with the IRS and has been working in tax and managing tax practices for the past 8 years. And then Mariana Mena is a CPA, just graduated recently. I say just graduated recently, graduated from the University of Puerto Rico and has spent the 3 previous years to Club Capital at PricewaterhouseCoopers. So got some great experts on the line today. And so without further ado, we will start diving into these tax minimization techniques. And the first, I will hand it over to Javier to talk about some of the most recent legislation due to COVID and some of the impacts that that's had for business owners and agency owners specifically.
Thank you, Micah. Thank you, and I hope everybody's doing well. Again, the beginning of every tax minimization technique, I think, has to do with the context in which we want to look at this. And these are teasers, so we can always go into more detail. We're going to go from the very macro to the micro. So generally speaking, the CARES Act, which everybody has heard of what it is, we're now up to, I don't know how many trillions now of money being printed, but it's been I would say a boom and a lifesaver to many business owners. What we need to understand is the purpose and the context of the law And to the extent that we understand that we can fit many tax minimization techniques in there. So what is the purpose of this law? So the purpose of law, in my view, is threefold. One is to keep the economy going, right? You don't want to shut down the economy. You want to make sure there is money flowing all the time, that there aren't many businesses closing down, so that when and if the pandemic closes, which ends, which I think it, hopefully shortly, then the economy can roar straight back, and you don't have a long ramp up period before the pandemic moves, before the economy moves again. So that's the first item. The second item is that you want to help individuals and businesses stay afloat. They don't go down. And then the third is that you want to help very specific industries that have been particularly affected. So if we understand this, we start to see what the impact has been. So for example, I know that many of us have gone remote. And in the context of going remote, we have sent probably monies to our employees to set themselves up as in a home office, computers, maybe chairs, maybe helping with the internet. Well, in the past, this was not allowed, but now in the context of the COVID help, this may be allowed. Another example is the employee tax retention credit. Long name, but it means that if you retain employees and you've suffered losses in your revenue, you can take deductions on your employer expenses of the wages. And then of course we have the PPP. Then we have things like being able to withdraw from your 401k without penalties. So these are very quick examples of the impact of the law in the context of what it attempts to do. I'm going to now move into the 5 components that we want to emphasize, but within this context, we can start thinking about how it affects you and how we can take advantage of these techniques. So I'm going to turn it over to Brian, I believe.
Good afternoon, everybody, and thank you for joining us today.
Next slide.
There we go. Thank you for joining us. As Micah mentioned, my name is Brian McCool, and I'm our tax manager here at Club Capital. I've been doing taxes for about 7 years. I've been an enrolled agent since 2017, and I want to take this opportunity to chat with you all about a tax saving opportunity that in my experience is commonly overlooked, and that is adding your children to payroll. So it may sound silly to some people, adding your kids to the payroll. It almost sounds like maybe you can't do it, but that's actually not the case. The IRS actually encourages you to do this. There are certain rules that need to be followed. However, much like with many small businesses where it's perhaps it's, just a father, mother who run something very small, they may have part-time help, they may have their family helping, it could even be parents, not just children. But with children in particular, there's an interesting opportunity here because a child can earn up to $12,000 before they're required to file a tax return. And so their earnings are actually tax-free to them, and you as a business owner have the ability to take a deduction up to $12,000 for their salary. Now, not to complicate this further, but it does depend, the rules depend a little bit on how your entity is set up. Are you a sole proprietor or are you a shareholder of a corporation? If you are a corporate shareholder, you are required to pay payroll taxes essentially for the child. However, their income is still tax-free. And if you're in a high tax bracket, it's not a bad idea to take this added deduction since payroll taxes are certainly not as high as the top income tax bracket. Now, some important caveats here. The child does have to actually work. For example, you can't hire your 3-year-old to be your social media consultant. That probably won't fly. The other thing is you have to pay them a reasonable wage. in the context of the work that they're performing. Now, as I said, $12,000 is the maximum that they can earn before they pay taxes, but something to consider is once a child earns up to $6,000, that's actually enough for them to max out their Roth IRA. And to anyone who's ever looked at an amortization table or does some investing themselves, you'll realize that it is extremely powerful to begin investing as early as possible into a Roth account to let those tax-free savings grow. And that's not the only deduction out there. I actually want to go ahead and pass this over to Mariana to talk about some important vehicle deductions that you can also look at when you're starting your agency.
Hi everyone. So now we will talk about vehicle deductions. One of the most common questions that we get is related to what agents can or can't deduct related to vehicle expenses. First and foremost, you can only deduct car expenses on your return if you're a business owner. This also means you can only deduct the portion of your car expenses that are related to the business. So if you have a car that you solely use for business purposes, you can deduct its entire cost. If you use your car for personal purposes as well, you will only be able to deduct the cost of its business use. There are two methods to deduct car expenses. One is using the standard mileage rate, and the other is using actual expenses. There are certain requirements to using the standard mileage rate. We won't go over all of them today, but I will say that in order to keep using the standard mileage rate in years to come, you must choose to use it the first year your car is available for business purposes. In subsequent years, you can choose to use mileage rate or actual expenses. The standard mileage rate for 2021 is 56 cents per business mile driven. This does not include commuting to the office. To use the actual expenses method, you must also determine the portion or rate of the business miles driven. This means that you will only be able to deduct actual expenses attributable to the portion of total miles driven versus business miles driven. Now, we've talked about total miles versus business miles a lot, and the reason for that is that difference or that distinction is very important. You need to have a detailed log of what is total miles versus business miles and other expenses. Other expenses, however, are easier to track because everybody uses credit cards, or if you use a check, you'll probably write down the reason for the check when you create it. So what's really important here is tracking the business miles. There are tons of apps that help with it, and we highly recommend business owners use them. In the event of an audit, you will need to provide a mileage log if you expense mileage driven for business purposes. Some examples of actual vehicle expenses you can deduct are gas, oil, maintenance and repairs, tires, registration fees, licenses, insurance, etc. And I'll stress, you can deduct these only if you use your car for business purposes and only the percentage that is business use. Now on the next slide, we will talk about depreciation.
Awesome. And just
so
before
let me just
no, go ahead, Javier.
Sorry, Mike. I just wanted to jump in and also share some, I guess, anecdotal information on some of the questions that have come from agents before. Among the questions that have come are to the extent of, what if I buy a car for an employee of mine, as opposed to having to reimburse the miles every time? Is that considered a benefit and therefore compensation? Or can I put that under the business as a whole? These are the questions. So I guess there is no easy answer other than we have to analyze what is the context for the use of the car. If it's only business, then it's very possible that it's a straight business deduction. As to whether it constitutes compensation, which means something you have to report in W-2 of the employee, something that should be discussed. But the point that we're making is that the use of the vehicle, as Mariana said, how many miles for the business, how many miles for the personal, whether the company owns the vehicle, whether it's personally owned, whether you are going to give it or at least grant it to the employee for a period of time that the employee is working, how far the employee lives. These are all variables that will have an impact on this huge deduction that is worth analyzing. Back to you, Micah.
Yeah, sure. And, especially when we think of, from the context of the agency owner, and obviously working with hundreds of agency owners on their tax returns and seeing the types of vehicles that they typically will have for their agencies, very straightforward when it tends to be a 100% business vehicle, maybe something that's a business vehicle that's wrapped, that stays at the office, that is used to go out to appointments, so on and so forth. Where this gets a little bit trickier is when, and as a lot of agents do, you use your personal vehicle for business purposes. When that's the case, we just really need to stress the use of keeping a mileage log. Upon audit, that's going to be one of the first things that will be asked, right? Is let's see the log for those business miles, not just a general sense at the end of the year of, it felt like a 70-30% split this year, right? I mean, we need to be able to have some proof to substantiate that. And also one of the things that Mariana mentioned too is something to work with your CPA on is establishing whether you're going to use that standard mileage rate or the actual expenses deduction, and making that determination from year one, because it will have a big impact over the life of that vehicle. And just from the accounting side of the house, it's a really big difference on the monthly financials, right? So are we going to be using our credit card for all of our business credit card for all of the purchases or not, right? If we're using 56 cents per mile, technically all of the purchases for the vehicle need to be done on a personal card, because you're going to take the reimbursement just based upon mileage, whereas actual expenses would normally be done with a business credit card. So just some things to consider, some things to work with your CPA to determine how are we going to do this, because it can change the behavior of how you kind of work and pay for the vehicle over its lifetime.
Hi everyone, so now we will talk about vehicle deductions. One of the most common questions that we get is related to what agents can or can't deduct related to vehicle expenses. First and foremost, you can only deduct car expenses on your return if you're a business owner. This also means you can only deduct a portion of your car expenses.
I think we were going through the same one there. Let's go to depreciation.
So depreciation is the recovery of the cost of the property over a number of years. Since you generally can't deduct the entire cost of property you acquired for your business, be it a vehicle, furniture for your office, or equipment, we will depreciate it over a number of years, or what's known as through the life of the asset acquired. This is also known as standard depreciation. The IRS has specific guidance of what that life of the asset should be. For example, it's 5 years for car or 7 years for furniture. We talked about vehicle expenses in the prior slide, and depreciating your vehicle is part of those expenses. As you can't claim depreciation on personal property, you will only be able to depreciate a vehicle up to the portion that is business use. Section 179 and bonus depreciation lets you recover all or part of the cost of qualifying property in the year you place the property in service for your business. Section 179 applies to certain qualified personal property such as machinery and equipment. There are dollar limits per year of how much you can deduct with Section 179, and you can elect out of the deduction if you prefer to save that expense for future tax breaks. Now, first year bonus depreciation has no annual limits on deductions, and that's basically the biggest difference between that and Section 179. You can carry any unused deduction forward for future tax breaks as well. So something business owners will see their accountants asked about in the first year of business is business startup expenses and organizational costs, also known as Section 195. These are expenses that are necessary for you to start your business. The rule is that you can deduct up to $5,000 of these in the year that you started your business. The rest, anything above $5,000, not exceeding $50,000, will be amortized or
depreciated for 15 years. Now I will pass it over to Javier, who will talk about meal and entertainment expenses.
Thank you, thank you. So let me give you one, and again, guys, I know this sounds incredibly dry, which it is dry, but let me share with you some applicability to what Mariana just said. So with regards to the depreciation and the car expenses, I know of a colleague who bought a Tesla Model X. Now, Tesla Model X, as you know, is a car that is over 6,000 pounds, which is automatically considered a work vehicle, right? Because luxury vehicles have a different definition. But if you have vehicles that are over 6,000 pounds, they are under IRS law considered automatically trucks. And as a truck, you can put it as a work vehicle. And if you take full depreciation, which are, Section 179, in the first year that you can, and you have enough income to take that in, it basically means that you're paying half price for the Tesla Model X. So listen to this, you can buy a Tesla Model X, and if you have sufficient income to absorb the full Section 179, it will cost you half as much. So if the car is 100,000, it costs you 50,000, which is the price of a nice Toyota. On top of that, there are tax breaks that are given to you on electric cars by the federal government and by the state government. So you get, and credits offset your tax liability 1-to-1, meaning that it's a double whammy. You get added benefit. So yes, it sounds dry, but yes, the potential benefit of talking to someone who knows how to use these laws in a legal fashion, of course, but using them to your advantage is just tremendous. So if you want to, get a Tesla for half price, talk to Brian, talk to Mariana. Hopefully they can guide you into that. All right, let's move on to the next slide.
Yeah, and just before we move on, again, just like Javier mentioned, some of this knowing the law is one thing, but knowing it enough and talking with a professional enough to utilize it to influence your decisions is another, right? So having the vehicle is one thing. Generally, a lot of business owners will know out there. Okay, yes, I'd like to be able to deduct some sort of an expense for the vehicle as I'm using it for my business. That's step one. Now knowing, additional aspects of the law allow you to really take it to step two, which is what is that vehicle? What type of vehicle should I use that I could maybe maximize the potential savings on my return? So it's just an example of taking it really to that next step to maximize your tax benefits.
Thank you, Micah. So I think we are coming up to the last deduction that we want to impart upon you today, and that's the business meals. Now, a bit of history. So it used to be, if you recall, that there was an allowance for what was called meals and entertainment. So meals was one part of the equation, and then entertainment was another. Well, in 2007, I believe, when 2017, I'm sorry, 17, when Trump helped pass the law, the entertainment piece went away. So the only thing that was left is the ability to deduct meals and 50% of that. Okay, so history is that we had meals for entertainment. Entertainment went out, right? So you can buy, say, theater tickets or sports events tickets, and charge them to the business. But it could be that if you take a client to a lunch or to a dinner, you could deduct up to 50%. With the CARES Act and with COVID, that was suspended or removed, let's say. So that, and again, remember that I talked about that the intent is both to help businesses and to target specific industries that have been particularly affected. And we're talking about the restaurant business in this case. So what they have allowed is that meals have now no limit on the deduction that you can take. So it's 100% deductible. 100% deductible if you, and I'm going to talk about the guidelines, if you are with a client taking them, or with your coworkers and a client and talk business and so forth, so on, is 100% deductible. And this is also important, that it includes not only when you eat in, but also when you take out. So again, an example of how we are targeting industries, we are expanding the money that is pumped into the economy by virtue of giving us tax breaks. And I believe that this is a perk that we business owners have to take advantage of. Now, very, very briefly, what are the conditions to do this? Does it, if you take your wife out and talk about business, does it, does it qualify? Well, let me give you the, basic guidelines. First of all, it must not be lavish, right? So if you go to a 5-star Michelin restaurant, I doubt you can deduct the whole thing. It must be reasonable. You can't spend thousands upon thousands, on drinks upon drinks. That's number one. Number two, you or one of your employees must be present at these luncheons or these dinners, and it must be in the context of seeking business. Now, this is quite vague, and we understand that it is vague. Notwithstanding, it's a perk that I think would be important and interesting for you to look out, because there are many advantages. And again, the whole intent is that we give money to the restaurant industry. So let's move in that direction. So I think that this is the end of the points that we wanted to mention in the tax minimization techniques. Again, it is just a teaser. These are just examples of what we need to be thinking about, of what we need to be talking to our accountants about, or of the things that we can take advantage of. What we have mentioned to you are techniques specifically geared and used regularly by agency owners. This is not applicable to manufacturing or anything else. And needless to say, this is what we do day in and day out. So we would be happy to consult or to advise in any which way that you would like. Micah, back to you.
Yeah, sure. Just before we go to the next slide, I think for just to be clear on this specific slide too, this is going to go into effect for the 2021 tax year, correct?
So it's both for 2021 and 2022.
Right.
So both years. It applies
for everybody
to both calendar years. So we.
Right. So everybody working, possibly right now, completing 2020 taxes, just a reminder that, there's still the 50% deduction for the meals account, which is also a really good way to be able to work with your CPA on identifying meals that might be internal to the team. Right. So anything that is like team development meals. So if there are meals for, say, a pizza for the office on a Friday, that is not something that's meant to be a 50% deduction. That's meant to be something that's more along the lines of employee relations. That would be 100% deduction. So there are things like that where if a lot of your meals kind of, or what would be classified as meals, would go in that direction, you'll want to make sure to delineate between the two on your income statement so that your CPA can work on those separately, right? And so that you're not reducing the deduction on meals that would otherwise then be 100% deductible. So just a caveat for the 2020 tax year, moving for the next 2 years, we will have that 100% deduction. So jumping into the next slide, and I'll let Brian cover some of this here. Outside of some of the 5 tips that we have today, one of the biggest tips to be talking about is tax planning and taking advantage of tax planning, really what that means is being proactive about your taxes, being proactive about your tax strategy, so that you're not rolling into tax season looking retroactively at the last year or saying, well, what could I have done differently, or what should I do next year, right? What we do at Club Capital is really stress this and work with our clients at the end of the year to plan. So Brian, if you want to just give a little bit of insight into kind of what our process is and why people should engage in that.
Sure. Thanks, Micah. First of all, I just want to mention how strange is it that something as simple as going out for a meal can have so many different tax consequences depending on what you're doing and what year you do it and what's going on. It's one of those things where you don't think much about it, but that's why we follow these changes in law, because they are always changing, and there's always a new rule in place. So tax planning is something near and dear to my heart. Here at Club Capital, we really pride ourselves on the tax team to be your advisor. A lot of the time when you deal with an accountant, it's to file taxes and you hope, well, maybe the accountant can save me some money on taxes. And of course we want to do that, but the key to that is really a successful tax plan. And so that's why we put so much effort into making sure that we stay in contact with our clients year round and make sure that we're doing everything that we can do so that when April rolls around, you already know what to expect. There's no surprise. And just to start this off, it's a bad joke that I found yesterday, but I'm going to share it. It says, there's an old saying, where there's a will, there's a tax shelter. So a little bit of accountant humor there. So tax planning is really made up of three parts, three general parts, and there can be some branches from each of those parts, but really timing of income, shifting of income, and conversion of your income. And so the idea here is that we want to use these strategies to help our insurance agents, both when you're starting a business, when you're operating it year over year. We take into account what your spouse, if you're married, what your spouse is doing, if you have children, what we can do there. And a couple of examples of this could be, like, let's say that you have children. Of course, when I spoke before, I touched on hiring your kids. Well, another thing to keep in mind is that the IRS does allow you to gift money to somebody. Both you and your spouse can gift money to somebody without any tax consequences every single year. In 2021, that limit's $15,000 per adult to recipient. So if you're married, you and your spouse could potentially give $30,000 to somebody without any tax consequences. So one reason you might do this, and this is just an example, is you could give, say, a vehicle worth a certain amount of money to somebody and then lease it off of them. That's one thing that you could do. Of course, there's some additional rules surrounding that. We're not going to get in too deep here. Another thing that you could do is when you're a new agent, oftentimes you have to buy things, you have to buy assets, you have to make many purchases. And you may want to consider, what's my tax bracket look like if I want to purchase something really big like a Tesla? What's my tax bracket in 2020? What do I think it'll be in 2021? Where am I going to really save money? So timing is definitely an important piece of this. Also, one thing that you could think about with income shifting is we have some expected, or timing rather, is we have some expected changes that are being proposed right now to the capital gains tax rate in the future. And I bring this up because the change is huge. Most people pay about 20% on long-term capital gains right now. And unfortunately, that could double in the future, in the near future. So these are things that you want to speak with your accountant about, because there's strategies you can use even to offset some of those gains. And finally, something I would touch on is just retirement planning. That's something that we really focus on with our agents, both for yourself as well as for your employees, because of course retirement is a great benefit that you can offer your employees as you grow to help with retention and attracting excellent talent, as well as we want you to be able to make sure that you're saving enough money for retirement and taking advantage of every opportunity that comes your way surrounding that, so that you're paying as little tax as possible on your retirement. And here at Club Capital, as I said, what we strive on the tax side is really just being your advisor. Yes, we do tax preparation, but my team and I are always available year round to answer any questions that you have, and we want to work with you every step of the way. And at this point, I would like to pass this to Micah to see if we have any questions, or if we can be of service in any other way.
Yeah, absolutely. And Kelsey, I think, might be able to help us out going through some of the questions that have come through in the chat box here. I think we can spend, I think we've got maybe 5 or so minutes that we can spend on questions here. Outside of that, I have put just some ways that everybody can contact us. If you want to reach out to us, our email and phone number is there. Or if you want to book a demo and just understand everything about Club Capital, you can do that by going to our website at www.club.capital. And that is with no .com at the end. We're that modern CPA firm, so we can't go traditional with a .com there. So, but Kelsey, what are some of the questions coming through that our team can help answer?
Yeah. First, before I jump into the questions, just want to say thank you guys. I don't own a business, but I'm very tempted to start one just so I can take advantage of all of these tax benefits. So some of these we already kind of went over, but just to confirm, we did have a couple agents ask about these principles being applicable to 2021. So if they're a new agent that just opened their business after the start of this new year, that these tax benefits that you guys talked about today can go towards their 2021 taxes when they're doing this next year.
I'll just jump in there and I'll hand it off to you, Javier, because I think this question came in early on where we might have been talking about some of the tax implications from the CARES Act and Coronavirus Relief Act. So it'll depend. So for brand new business owners that started this year, it is certain things that surround some of the COVID relief packages, such as PPP or employee retention credit, I believe needed to have started their business by February of 2020, if I'm not mistaken. So some of these might not apply to brand new business owners this year, but it's definitely something to look a little bit further into. And Javier, I'm not sure if you have any more insight into that.
I think you're absolutely right, Mike. It all depends on what it is that we're talking about. So some tax breaks will apply to 2021 and some will not. And it's a matter of seeing which ones would be applicable to the very specific circumstances.
Okay. And then we did have a great question, just touching back on having your children involved in your business. This agent wants to know if we had our children in office for months while they were online learning and we had to buy them lunches and breakfasts instead of them eating at school, are those able to be deducted in any way as a business expense?
So I'll jump in here.
Let me try this. Okay, go ahead, Rob.
So for this particular question, and it is a great question, so thank you for asking. Now, what you need to be aware of here is that we're looking at business deductions. And so if the children were working in the business and you fed them while they're, at your convenience while they work, that's one thing. But if they're just in the office and they're there while they're doing online school and you provide a lunch, in that particular scenario, without any additional information, I would have to say that in that case, that would not be a deductible expense, no.
So let me, if you don't mind, Brian, let me turn it around just a little bit and say, that the meals will be deductible to the extent that you make your children employees of the company. So we just gave you the tips of how to make them employees of the company and how to have that be a tax break. So to the extent that you follow the guidelines for having family members be employees of the company and take that tax break, then the benefits that are given to the employees, including your children, are also deductible. So it's actually a potential double deduction if you do this. Yeah.
Thank you, Javier.
Very interesting. That was really all the questions we have. For those of you who are still with us, if you do have any questions, I mean, these are tax experts, so feel free to ask away. But the lack of questions tells me that you guys did a great job being very thorough with the information that you presented today. So thank you guys again so much. If any other questions do come in, if you are a Quote Wizard agent, feel free to reach out to our agent education email about this webinar, and I can pass it along to the Club Capital guys. But yeah, thank you to everyone who joined today. And if you found value in today's webinar, make sure you join us next week on May 5th at the same time, 1 p.m. Eastern, where we'll be hosting Jeremy Olson and Kristen Isaacson from Roleplay at the Olson Agency. They'll be walking agents through overcoming a very common objection with leads, which is I did not request a quote. So Quote Wizard agents, keep an eye out on your inbox for that invite next week.
And the last thing here, I think there's a question on if people are going to be able to have this presentation. And so I think the biggest thing is that all of these presentations with the Quote Wizard agent education, I think I'm calling it series, agent education series, but are going to be hosted online on your platform, right?
Yes, they will be. And we're launching our official agent education portals this summer. We do have a temporary site where we are housing these videos, which I will send out an email to all the participants today who are Quote Wizard agents.
Awesome. Thanks for having us, Kelsey.
Of course. Thank you guys. Always a pleasure.